Some have dubbed this crypto's Lehman moment. The bankruptcy of the crypto giant FTX, as well as the departure of its founder, Sam Bankman-Fried, has left customers in the dark and investors writing off what once appeared to be the next big thing in technology. And that happened in a matter of days. However, in the intricate realm of cryptocurrency, such a collapse can be difficult to interpret. Here's the gist of what happened. What exactly is FTX? FTX is a digital currency exchange that allows users to purchase and sell digital assets such as Bitcoin, Dogecoin, and Ether. In recent years, such platforms have grown in popularity as more consumers want to participate in cryptocurrencies without having to deal with the technical aspects of such transactions, such as setting up a crypto wallet. How did it grow to be so large? The company, which was created in 2019, came to international popularity swiftly thanks to a succession of high-profile acquisitions, strong marketing methods, and inexpensive trading fees. Kraken, Coinbase, and Gemini are among the platforms that compete. Even individuals who were unfamiliar with the technology were enticed to FTX by the promise of being able to store their money in accounts and receive significantly higher yields than at traditional banks. Major venture capital firms also invested about $2 billion in the company. The 30-year-old creator of FTX, Sam Bankman-Fried, became the face of the firm and, to some, crypto in general. Celebrity endorsements and significant sports partnerships make FTX difficult to overlook. The very first red flags. Crypto began to thrive not long after Bankman-Fried founded FTX. Bitcoin's price, which had been trading around $10,000, skyrocketed in 2021, reaching more over $64,000. Venture capital money poured into all things blockchain and crypto platforms shifted their focus to target users other than the technologists and blockchain evangelists who had previously driven their rise. The price of Bitcoin, which is widely regarded as an indicator of the broader crypto market, has plummeted from late 2021 highs. It is currently worth roughly $16,000 per share. Other cryptocurrency and token prices quickly followed suit. Many major platforms had already shut down due to the overall decline in the crypto industry, but FTX appeared to be immune, even buying up some of its struggling competitors. However, things began to shift early this month when CoinDesk, a crypto-focused digital media website, disclosed the balance sheet of Alameda Research, a crypto investing firm owned by Bankman-Fried. It revealed that Alameda had a considerable amount of FTT, a digital currency established by FTX. Even though the FTT had a market value, if the price fell, Alameda would be forced to declare bankruptcy. What is FTT? FTT is a digital currency developed by FTX that functions similarly to cryptocurrencies such as Bitcoin. Many crypto platforms are now creating their own tokens in order to entice users to use their services by providing incentives related with their tokens. As a result, tokens can function similarly to shares on the platform. However, not all blockchains, cryptocurrencies, or tokens operate in the same way, and many are no longer distributed in the same way as Bitcoin. Tokens on a blockchain can be created by a single entity, like with FTT, which was issued by FTX and distributed as user rewards. FTT was also less transparent than other tokens, making it difficult to keep track of how many tokens were created. FTT may be bought and sold, but trade was limited. The token was also stored by other platforms. A virtual bank run. Following the release of Alameda's financial sheet, Changpeng CZ Zhao, CEO of the crypto platform Binance, a competitor of FTX, declared on November 6 that his business would sell out all of its FTT tokens. The cost of FTT has reduced dramatically. As the price fell, many FTX consumers began to withdraw their assets from the platform. Though the breadth of the linkages between Alameda and FTX were not yet known, a slew of recent crypto platform failures had already left the crypto community on edge. Those withdrawals would resemble a typical bank run, in which people concerned about a bank's viability rush to withdraw their funds before the bank runs out of cash. The site drained billions of dollars. On November 8, FTX ceased allowing consumers to withdraw funds from the site. A balance sheet that is imbalanced. What was not yet known was the extent of Alameda's ties to FTX, or how bad things had gone for Bankman businesses. These linkages, as well as FTX's financial difficulties, became obvious in the days following the company's decision to halt withdrawals. Bloomberg, the Financial Times, the Wall Street Journal, and others cited unidentified sources as suggesting that FTX needed $8 billion to fill the difference between what it owed and what it could pay out. NBC News has not confirmed those stories, and Bankman-Fried told a Vox journalist over Twitter DM on Monday that he needs to raise $8 billion in the next 2 weeks to make things right with account holders. The Wall Street Journal and CNBC, citing anonymous sources, alleged that Alameda traded with FTX funds. In the Vox interview, Bankman-Fried appeared to confirm claims that monies had been transferred from FTX to Alameda, adding that he felt Alameda had adequate collateral to handle the transfers. Soon later, blockchain analysts monitored the movement of $400 million in assets out of FTX accounts, while the reason for the transfer was unknown. In a series of text exchanges to Reuters, Bankman-Fried denied that monies were secretly transferred from one company to the other. He attributed the transfers to an internal labeling error. According to a court statement by FTX's current CEO, John Ray, who helped lead Enron through its corporate bankruptcy process in the early 2000s, it is impossible to determine how and why the company's money were managed the way they were. This is because FTX and its related companies reportedly did not follow conventional financial reporting processes. Normally, a firm creates balance sheets multiple times a year that provide reliable information on the company's assets, what it owns, and liabilities, what it owes, among other things. According to bankruptcy court records, Bankman-Fried's balance statements were never audited, which means there is no trustworthy account or paper trail of what money the company had and where it went. According to a court statement from FTX's current CEO, Ray, the company's poor management and financial opacity were unique. I have never seen such a severe collapse of corporate controls and such a complete absence of trustworthy financial information as occurred here in my career. Ray stated that the organization has secured $740 million in Bitcoin owned by the numerous entities that comprised FTX and Alameda, a figure that is only a fraction of what they expect to recoup. A lifeline was severed. Bankman-Fried lunged for a lifeline as symptoms of a larger crypto crash loomed before the entire magnitude of the crisis became apparent, anxious to keep his enterprises afloat. Zhao, one of FTX's early investors, stepped in to help his old adversary. On November 8, he announced that Binance would purchase FTX for an undisclosed sum, effectively bailing out the troubled corporation. Binance soon withdrew, citing accusations that FTX had mismanaged user funds and information acquired via the customary due diligence procedure that accompanies such transactions. Bankman-Fried has addressed the company's issues on Twitter, where he is still active. He started a lengthy thread last week with one, "I'm sorry. That is the most important thing. I effed up, and should have done better," he added. Bankman-Fried stepped down as CEO of FTX on November 11, and the companies he controlled filed for Chapter 11 bankruptcy. According to the Wall Street Journal and the Associated Press, both citing anonymous sources, FTX is now under investigation by the Securities and Exchange Commission and the Department of Justice. NBC News has not independently verified the stories.